So today I want to get my strategy right, and the first thing I'm doing is cracking structures. So to crack structures, you first have to understand market structure. This is an uptrend, right, and this is a downtrend, right. This is the whole of everything. It's the whole of everything, right. This is structures at itself. But now to crack structures, we get to understand that this bullish trend consists of highs, lows, a break here, and you go. You keep going like that, right? This is how structures are formed. Breaks. Could do this to go lower. Could do this to go lower, right? And no. And this is what structure is. And when you have a structure, you identify it like this coming from an uptrend, then you can impute premium and discount. The whole idea of premium and discount and how it works is it gives you areas for best buys and best sells, a premium price with best buys and best sells. So basically this is it, structures. And we call this main structure here, we call this one here, we call it the macro structures. We call it the macro structures. Sorry, call this here the macro structures. Macro because it's a major one, macro structure. And those tiny in between structures, we call it the micro structures. Call it micro structures. The idea is that every microstructure is coming from an overall macro structure. So this microstructure, if you zoom out, you see this as a macro structure. Premium and discounts are only drawn on the macro structures, not on the microstructure. That is a rule. Premium and discounts. So we're going to keep this here as rules. Rules. Rule number 1. Premium and discounts. Premium and discounts are only drawn on macro structures. I'll explain why. These are first rule. Premium and discounts are already drawn on macro, because you won't know the premium in a bullish market like this. You can't go and draw. Well, I'll explain later that when we actually come down to the charts, this is the actual low and this is the actual high, right? Not everything going up, because everything here are just series of higher highs and higher lows, higher highs, higher lows. Everything is where you draw to know the areas where the best areas to continue to buy from in the bullish market, right? This is where swing setups are formed. When price maybe goes and hits, let's say something here, right? You can buy up, and you know you are buying up to where externals, buying up to externals. So the first rule is that premium and discounts are only drawn on our structure. So everything said, I Now we want to also look at how market structure break of market structure, BOS, how BOS occurs. So BOS can either be break of this low or the first failure high. You see this high that fails, you can start giving us an intention of the market to do what, to change direction. So this failure high too can be regarded as break of structure. So with this said, we are going down to ranges. What are ranges? Let's go down to ranges. So next thing up is ranges. Right? Range basically is a structure that contains a strong high, a strong structure, and a weak structure. Ranges, market structure, ranges are market structures low and high, low and high, and high. Yeah. That is made up of strong and weak structures. I explained that to you. So what do you call a strong structure? A strong structure basically, right, is a structure that takes out liquidity. And I explain. So if we go back to here, I want to know our range, right? This breaks here and it takes out this liquidity here, right? So, and in another sense, you can just say strong structures are change of characters, depending on how you want to call it. But I call structures structures that take liquidity, right? So, in let's say in an uptrend, now, right? Uptrend is series of higher highs and higher lows, right? Right, this is an uptrend. So we will look at the microstructure. We will try to do something like this. Right, do something like this, like this, like this. Right. And you know, before price comes here, right, price has done this. Even if you didn't complete this, it's has to go high again. But if we are looking at a bullish market, so let's just call this or this. So what do you now call the strong structure? Is one that takes, once this liquidity has been taken out, right? Strong structure when in a range. The strong structure is the one that takes out liquidity. So this takes out liquidity and goes on to make a high. Once this high has been broken, like this becomes a strong structure, strong low. Yeah. But some people say is the low in a bullish structure, the strong low is the low that is, because for bullish market you have to have a strong low and a weak high, because you're going like strong from a strong low to a weak high. So price then retraces, creates another strong low to a weak high. For bullish market, the lows have to be strong, so meaning that there's liquidity has been taken from that low and price is finding difficult to break that low while creating new highs. It's a strong low because if market failed to break the low and then went ahead to create a new high. That's basically strong lows. But in a different sense, since we also define it as the low that has liquidity, if you look at the market where price comes here, right? This is another block, right? And price comes like this. Just hit this other block. Now we're not having a now what I call it it's a strong one. Because now this takes another block. What happens there? It's actually a strong low once here gets broken. It does exactly takes out liquidity, creates a high. This thing takes out liquidity, doesn't create a high, so it just instead becomes weak low, right? So you have this liquidity creates a high. So that is what strong structures are. Structures that takes out liquidity and goes ahead to break a high. That's what we call strong structures. Weak structures are structures that are created from strong highs. So once this breaks, this becomes a weak high, right? Makes a low, weak high, makes a low, weak high. Price should be taking this out, right? Should be taking it out. So when we have the idea of this stronger and weaker, then we can have range, right? So if price comes to hit another, if it comes here to hit another block, right? In just let's say in the market now, price moves like this, creates another breakthrough, comes here, hit another block. Now because this has taken a liquidity and gone ahead to break a high, right? It becomes a range, a trading range. So we could trade within this range. That's what it means. Could trade within the range. So that's the idea of ranges. So now we're going to look at we can apply this to bearish structure too. We're going to look at market cycle. We can look at market cycle and how market changes from bullish to bearish, right? We're going to do that. So in this kind of market now, we have strong low, and a weak high. Now this is microstructure. So now in this market cycle, basically is saying that the market will go from premium to discount, seeking liquidity. And once it has taken enough liquidity, when it has taken the liquidity it wants, it does what? It moves back to continue its original move. That is basically market cycle. So now, before going into market cycle, let's talk about liquidity. So there are different types of liquidity. There's inducement liquidity. There is transactional liquidity. And there is structural liquidity. This is structural liquidity here. Structural liquidity is the last liquidity to the strong structure. This is strong structure. This becomes its structural liquidity. When price breaks, if this is a strong structure, right, this will become what? Structural liquidity. If this here is a strong structure, what happens? This becomes what? Structural liquidity. But if this is not a structure, this is not a structure. This is structural liquidity, right? Because all these are not protected. Transactional liquidity basically is the liquidity coming from the opposite side of the curve. So in every market there is a buy curve and there is a sell curve. So there is a sell curve and there is a buy curve. So we call this the buy curve. Every market there is a sell curve and there is a buy curve. So transactional liquidity are the liquidities or the failed structures from the opposite side of the curve. Basically, that is transactional liquidity.